In the early 17th century, the Dutch Republic, a beacon of trade and prosperity, witnessed an extraordinary phenomenon. A flower, the tulip, became the center of a financial mania that would echo through history. Known as tulip mania, this episode saw tulip bulbs traded at prices exceeding the cost of houses, only to collapse spectacularly in 1637. Often cited as the first recorded financial bubble, tulip mania offers a timeless lesson about human psychology, speculative excess, and the fragility of markets. To understand tulip mania, we must first set the stage in the Dutch Republic during its golden age, 1588 to 1672. The Netherlands was a global economic powerhouse, driven by the Dutch East India Company, VOC, the world's first publicly traded company, and a thriving maritime trade network. Amsterdam emerged as a financial hub, with a burgeoning middle class and a culture of innovation. Wealth flowed into the hands of merchants, artisans, and even laborers, creating a society flush with disposable income and a taste for luxury. Tulips, introduced to Europe from the Ottoman Empire in the mid-16th century, captivated the Dutch. Their vibrant colors and unique patterns, caused by a virus later identified as the tulip-breaking virus, made them a status symbol. By the early 1600s, tulips were not just flowers, but emblems of wealth and refinement, adorning the gardens of the elite. This cultural fascination set the stage for an economic frenzy. The tulip's allure turned speculative around 1634, as demand for rare bulbs outstripped supply. Unlike common flowers, tulips took years to propagate, and certain varieties, like the Semper Augustus with its flame-like streaks, were exceedingly rare. Wealthy collectors began trading bulbs, and prices crept upward. What began as a niche market among horticulturists soon attracted a broader crowd: merchants, craftsmen, and even farmers, drawn by tales of quick profits. The Dutch economy, awash with liquidity from trade and low interest rates, fueled this speculation. The VOC's success had normalized stock trading, and the concept of investing in intangible assets was familiar. Tulip bulbs, though physical, became a kind of proto-security, traded not for planting, but for resale. This shift marked the birth of a bubble, as prices detached from the bulb's intrinsic value, essentially their utility as flowers. Tulip mania's mechanics reveal the anatomy of a classic financial bubble. The market operated through informal exchanges, often in taverns, where traders gathered in colleges to bid on bulbs. These transactions relied heavily on futures contracts, agreements to buy bulbs at a future date, often before they were harvested. Buyers paid a small deposit, expecting to profit by selling at higher prices later. This leveraged trading amplified gains, but also risks, as speculators committed to prices they couldn't always cover. By 1636, the market exploded. Bulbs changed hands multiple times a day, with prices doubling weekly. Historical records, though debated, suggest a single Semper Augustus bulb fetched 6,000 florins, equivalent to a luxurious Amsterdam canal house or 10 years' wages for a skilled artisan. Common bulbs, too, soared, drawing in ordinary citizens. The frenzy was democratic. Bakers, weavers, and maids joined merchants, all betting on endless price increases. Human psychology drove tulip mania's ascent. Greed, fueled by stories of overnight wealth, created a fear of missing out. Social contagion spread the mania as neighbors and friends boasted of profits. The Dutch, known for thrift, abandoned caution, convinced that tulip prices would never fall. This time is different mindset, a hallmark of bubbles, blinded participants to risks. Cultural factors amplified the frenzy. The Dutch valued novelty, and tulips, with their exotic origins, fed this appetite. Taverns where trading occurred were social hubs, blending alcohol, bravado, and speculation. The lack of regulation, unlike modern stock markets, allowed unchecked exuberance. Media, in the form of pamphlets and ballads, hyped the tulip trade, while satirical songs later mocked its collapse. By late 1636, tulip prices reached absurd heights. Records cite bulbs trading for carriages, livestock, or entire estates. Yet, Cracks appeared. Some traders, sensing unsustainable prices, began selling. The market's reliance on futures contracts meant many owed far more than they could pay if prices fell. The bubble's peak was a moment of collective denial, as speculators ignored warning signs. The trigger came in February 1637, an auction in Harlem. Buyers, suddenly hesitant, failed to bid, leaving sellers with unsold bulbs. News spread, and confidence evaporated. Panic set in as traders rushed to sell, but buyers vanished. Prices plummeted. Some bulbs fell from thousands to mere florins overnight. The futures market collapsed, leaving many with worthless contracts and crushing debts. The collapse of tulip mania was swift but not catastrophic for the Dutch economy. Unlike modern crises, the tulip trade was a side market, not central to banking or commerce. Wealthy merchants absorbed losses, while smaller players, artisans and laborers, faced ruin. Courts, overwhelmed by disputes over unpaid contracts, often voided them, deeming the trade speculative folly. The Dutch Republic, buoyed by trade, recovered quickly, and tulips remained a beloved flower, though their speculative allure faded. Socially, the bubble left scars. Public trust in speculative ventures waned, and moralists decried the greed that had gripped society. Pamphlets and artworks, like Jan Bruegel the Younger's satire on tulip mania, depicted speculators as fools. The episode became a cautionary tale, etched into Dutch culture as a warning against irrational exuberance. Tulip mania scale and impact have sparked debate among historians. Early accounts, like Charles Mackay's 1841 Extraordinary Popular Delusions, exaggerated its devastation, painting it as a national catastrophe. Modern scholars, such as Ngolgar, argue it was smaller, affecting a limited group with losses overstated. Contracts were often informal, and many were renegotiated or ignored post-crash. The Dutch economy's resilience supports this view, as trade and banking continued unabated. Yet, the bubble's significance lies in its archetype. It mirrors later crises: South Sea Bubble, dot-com crash, 2008 housing crisis, where speculation, leverage, and herd behavior drive markets to ruin. Economists like Hyman Minsky and Robert Shiller emphasize that bubbles are inherent to markets, driven by human nature. Minsky's financial instability hypothesis sees stability breeding risk-taking, while Schiller's irrational exuberance links narrative-driven speculation to crashes. Tulip mania illustrates both. A stable Dutch economy enabled risk, and tulip stories fueled the mania. Preventing bubbles is daunting. Regulation can curb excesses, but human psychology resists change. Individuals can avoid bubbles by diversifying investments and questioning hype. As Schiller notes, understanding historical bubbles equips us to spot warning signs, rising valuations, media frenzy, or speculative instruments.